Yeah, you're pretty much right there. Okay, next is Halma, which reported earnings this morning. The stock jumped 8%, pretty much after at the open. And then it sort of came back to being plus about 2.75%, and it finished the day just under 4% higher. So it did shoot up, and then investors sort of thought, okay, maybe it was kind of pretty good rather than great. And that was sort of my reaction, actually. I initially thought these looked good, and I said to you before the market opened today, I think that's strong from Halma and expect this to go higher. And it did, and I was right. And then I looked a bit more closely, and I thought, well, actually, I'm not sure they were that good. Partly for reasons that are just on a closer inspection, and partly for reasons that are not Halma's fault at all. And I'll come to those in a moment. So then it sort of came back to maybe plus a couple of percent or so, and then finished somewhere in between. And I sort of think that roughly tracking my reaction. I'm not saying that my the piece that I put out on Halma this morning on full dragged the share price back down, but something did. Anyway, here is what happened. This is their full year reports for the year that they call 2024. It ended earlier this year, basically. They run start of April to start of April. Pretty much. We'll come back to that point in a moment too. So revenues came in at 2.25 billion, which was 11% growth. Adjusted EPS, because why not? Adjusted EPS for them, by the way, is basically a free cash flow measure with some depreciation added back. It's not quite as precise as that, but they try and smooth or normalize free cash flow and then adjust for depreciation a bit. But it's 94.23p, which was up 14% from the year before. And the dividend, because they do pay one, was 23.12p, which was up 7%. On that adjusted EPS / I'm calling it kind of free cash flow metric, they trade at a PE ratio of about 33 at the moment, which is quite high. But this is a company that has been growing very well. It's a growth stock. It has lots and lots and lots to like about it and has done for quite a while. And the market quite liked these results. Here's what I think they liked the most, which was that this is a serial acquirer. It's a decentralized conglomerate. They operate in three main segments. There's industrial safety, agricultural monitoring, or something like that, and life sciences. And 9% of their growth was organic, i.e. coming from companies they already own rather than ones they've acquired. 2% was driven by acquisitions. The market generally is pretty positive on this thing when it's growing its own businesses and less positive when it's relying on buying in growth. There are reasons for that. There's always risks when you buy them. The integration doesn't go the way you hoped. The businesses don't perform as well as you wanted. Maybe you pay slightly too much for them and so on, and you end up wasting your money. But that's what the market liked quite a bit. So largely driven by organic growth at 9%. That is pretty impressive. I'm not sure I necessarily see it the way the market does on this, I think, assuming I'm right about what the market was liking. But here's some stuff about why I maybe hesitated a little bit. Those are good growth numbers, by the way, nothing to dislike there. At the half, which is Halma, by the way, puts out kind of quarterly trading updates, quote unquote, and halfly results, like a lot of UK companies do. And different UK companies treat their trading updates in different ways. Some of them treat them as largely, here's what the sales have done. Some of them treat them as sort of nearly quarterly updates, and some of them treat it as an opportunity to say things with absolutely no numbers whatsoever. And Halma is down the absolutely no numbers whatsoever. You have to try and interpret what they mean by good or strong or resilient or any of those things without any sense of what that really means in terms of, well, how much did the damn revenues go up? Anyway, at the half, so that was the last time we got any numbers out of them, they were looking at 13% revenue growth, 17% EPS, and 12% organic. So they've slowed down in the second half, is what that means. And that's slowing down off a pretty high base and still reasonable, but it was slowing. And it's still moving forward, but slowing. So I think that's worth bearing in mind when you look at some of these kind of growthy stocks. They're guiding for upper single-digit organic revenue growth going forward, which is roughly where they are at the moment, I think. They've gone from 12% organic to sort of 9% organic. That's actually a bit of a pickup then that they're looking for if they're thinking they'll stick at that level. Their order book, they say, is higher than it was last year, so I should hope it was, because you've acquired some businesses and you're meant to be a growth thing. So this number better go higher. At 33 times earnings, it hadn't better be going backwards. Here's what I liked about this statement, though. I thought that guide sounded fine. What I liked was their return on tangible and invested capital was 15%. It was up from 14.3%. So in other words, wherever they're sticking their money, whether that's organic or acquisition or whatever, it's going quite well. They are getting better returns when they put capital out than they were before. Slightly, but generally speaking, that number's the one that kind of matters to me. My sense of these is I don't really care whether they invest their money internally or whether they invest it into acquisitions. What I care about is that they invest it well. And if there's chances to do that within the organization, cool. If not, well, go buy something. But go buy something and make sure that you're getting a decent return off of it. So that's my main takeaway here. Here's the thing that gave me slight pause on this. At the moment, we're looking for signs of weakness, especially from companies that do 44% of their business in the US. And this looked like a pretty resilient kind of set of results. But their year-end cuts off on May 31st, which means that these results only go up to then. Liberation Day was sort of immediately afterwards. So apart from the kind of more recent start where it says slightly higher and the guide for the year, these results tell you nothing about the post-tariff trading stuff. And I'm wondering exactly whether the next report might not be so. I mean, the next report is a trading update, which will say any old thing. But the next set of numbers might not be so strong as this one. I'm just keeping my eye on that a little bit here because I don't think anyone really knows what's going on with tariffs. I'm not sure they have for a little while. Halma has some things that should make it resilient against that. They trade in safety stuff, which is usually kind of required rather than discretionary one way or another. But I am aware that I'm looking at these strong results and not taking them as a sign that they're making their way through tariff stuff yet, because the tariff stuff was largely after the end cut off for these results. That has nothing to do with Halma. That's not a criticism of them. That's just when their year ends. Steve, what did you think of this, if anything?
So my initial thought, Steve, was this is likely to be a bit of sort of like growth pull forward kind of stuff. So when I was looking at this, I was thinking, is this perhaps, the tariffs are pulling some of this growth, people just trying to stock up essentially on bits and bobs before these tariffs kick in. But actually, I think I'm probably wrong on that. I'm just looking now, about 90% of US sales seem to be generated and supplied from in-market. So there's only a fraction on top of that, which is unlikely. It's actually only 70% when you look outside of the US as well. So they must have known tariffs are coming, Steve. They've almost set up for tariffs. Environmental analysis division, growth of 18%. That looks pretty good. 80 basis points of operating margin expansion as well, despite spending for 108 million on R&D, which was a higher, about 4.8% of total sales as well. So and the KPI for that is 4% of sales. So that department is spending more, but the growth is good out the back of it as well. 7 acquisitions in the year, Steve. About 160 million quid in acquisitions. So that's 15 acquisitions in the last 2 years, which kind of stamps home that point you was making earlier about when companies are good at making acquisitions, they tend to be good at it, and when companies are bad at making acquisitions, they tend to be bad at it. And I think we can put Halma in the good camp here. Just looking at the broker report from Investec as well, Steve. They're giving it. They think it's got enough growth left in it at least to support a PE ratio of around 32 in 2026, which is about where it is now, Steve. So whatever you get in earnings growth, they're probably expecting in share growth. So if you get 15-20%, that's kind of the return they would expect in the year, which is good. Although I would probably sort of preface that by saying nobody knows the answer to that. I don't know, Steve. I think this looks okay. I think this is, it kind of, it reminds me, it's not as good, but it's very similar to the how Diploma performed, really. These sort of acquisition-heavy, decentralized companies seem to be having except for Bunzel, seem to be having a decent year so far, Steve.
Yep, exactly that. You say that. We might get to another one that hasn't in a moment, but these are very similar companies. There are 2 reasons to prefer Diploma over Halma that I can see at the moment. One is that it's smaller and therefore has a bit more, maybe, runway for growth here, although I'm not super sure that Halma, when we start worrying about conglomerates getting too big, we start worrying in sort of Berkshire Hathaway terms or something like Illinois Toolworks or whatever. Neither Halma nor Diploma is anywhere near that size just yet. They still have plenty of opportunities ahead of them. That PE number is sort of tricky at 33. I've got it at 33 times adjusted here. I'd be pretty pleased if I thought it was going to hold in there. And I wonder whether I ought to run it through a kind of Sven Carlin spreadsheet type thing to see exactly what happens, because I would expect some multiple contraction to come through. The question is whether it can outrun that in growth, and I don't honestly know, to be honest with you. So I'm a little unsure as to what to make of that. But yes, they do acquire well. I'm not buying this, by the way, at these levels. My sense is that I have a slightly different view to the market here. When the market sees acquisitions taking over from organic growth, they tend to go off this quite a bit. And I don't mind that particularly. I think that's a sign the company's doing whatever the best thing is. So I think my opportunity to buy this insofar as it's coming. I did buy it once, by the way, and then sold it again. I bought it during the mini budget thing when everything went down, and the stock I happened to be looking at the time was Halma. So I was like, all right, I'll buy this. Don't regret that. I think it was a pretty good move. Did sell it. Also, don't necessarily regret that either. But I suspect there will be times when this will look uglier, not when the market thinks, yeah, these are pretty good results. Well done. Keep going. Move forward here. So it stays on the watch list for now, but I do like this company quite a lot, and I would like to find its Bunzl moment and then buy it. As you say, Bunzl been under a bit more pressure recently.
It's happening a lot at the moment, and Steve, I've been looking at 3i again after our conversations, and I'm not sure. I just can't seem to make it work. I think it needs to be about, I don't know, a 5 or so under before I would seriously consider it. About 10 or 12% down, and it got there in sort of the middle of April, didn't it? So maybe we've got to wait for another one of those times. But I think 3i is pretty high on my list, Steve. And I think if we're having a problem with Halma, I don't know. I think I'd sooner wait for 3i out the two of them. I don't know, Steve. Shall I do wise, or do you want to comment?
No, let's do wise. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.